Does the stock market feel like a gamble lately? Are you worried about running out of money in retirement? Or maybe you're just tired of feeling like you have no control over your financial future. Welcome back to Reflections in Real Talk, where we dive into real life money matters. I'm Judy, and today we're talking about dividend stocks and why they just might be the steady income stream you've been looking for to provide you peace of mind and real tangible income, even in a shaky market. Dividend stocks can give you stability even when the market feels like a roller coaster, or if you're retired and want a steady paycheck. And here's the key. Dividend stocks can provide income now, not just someday in retirement, when managing cash flow is everything, and that can be a game changer. I'm just a regular person like you, working at a job trying to save for retirement. Unlike many other YouTube channels talking about finance, I'm not a financial advisor, and I have no interest in having you sign up for my services. I'm just providing objective information that you can use yourself to make your own decisions, whether you handle your own investments yourself or hire a financial advisor. But my hope is that after watching these videos, you should be able to ask the right questions and be informed. At the beginning of any financial assessment is usually a risk tolerance questionnaire. Most financial advisors or online portals will ask you to define that in order to select the right investment strategy. But that question can really depend on your life stage and the current condition of the market. For example, if I ask myself what's my risk tolerance, well, it really depends. Markets are up or down. I have a high risk tolerance when the markets are up. When they're down, my risk tolerance is much lower. Nobody likes to see their portfolio drop 10%, 20%, 30% or more. And when market volatility hits, many people are looking for a safe haven or a place to park their money that won't have the tremendous ups and downs of the stock market in general. This is when people start considering dividend stocks as more steady alternative to investing in the S&P 500, for example. This is going to be part one of a two-part series, maybe three, because there are a lot of details to dive into in order to properly evaluate investing in dividend stocks to determine if it's a good investment strategy and how it compares to alternatives. And if you do decide dividend stock investing is for you, how do you actually go about doing it? Let's start with the basics. What is a dividend stock? A dividend stock is simply a share of a company that pays you a portion of its earnings on a regular basis, usually quarterly. These payments are called dividends. That's real money paid directly to shareholders. It can be reinvested or used as income. Unlike traditional growth stocks that reinvest profits to grow fast, dividend stocks are often tied to companies that are stable, established, and have a track record of sharing profits. Think utilities, consumer goods, or healthcare giants. Traditional growth stocks are focused on capital appreciation. They often offer higher risk and higher potential reward, but don't usually pay dividends. Now, let's compare that to dividend stocks, which provide income in the form of a dividend. They are often less volatile and have potential for slow but steady growth. So are dividend stocks classified as growth or value? Most dividend stocks fall under the value category. Value stocks are typically well-established companies that are trading below their intrinsic value and often are less volatile. Compare that to growth stocks, which are more speculative and can include newer companies that are reinvesting profits to scale quickly. But here's the thing. Some dividend-paying stocks like Apple blur the lines by offering a small dividend while they're still delivering growth. So now to put it in perspective, let's compare dividend stocks to other investment options. Index funds. They are great for diversification and often include dividend-paying stocks, but don't focus on them exclusively. CDs and money markets may seem like a safe haven, but they offer lower returns, especially after inflation. Bonds, which are more stable than stocks, but yields have been lower in recent years. Target date funds. Target date funds automatically adjust risk over time, but may not generate high income. Gold and Bitcoin. Neither gold or Bitcoin offer any income generated, can be speculative, and don't offer a hedge against inflation, depending on who you ask. REITs or real estate investment trusts, which can pay high dividends, but also can be sensitive to interest rates. TIPS or Treasury Protected Securities are designed to protect against inflation, but with much lower returns than dividend stocks. Now, let's pause here and look at TIPS versus dividend stocks as an inflation hedge. TIPS adjust their principal with inflation. They're safe, but right now their yields are below 2%. Dividend stocks, on the other hand, can grow their payouts over time. For example, companies like Johnson & Johnson and Procter & Gamble have increased their dividends year after year, outpacing inflation. Here are the historical performances over 20 years. The S&P 500 Dividend Aristocrats Index, companies with over 25 plus years of dividend growth, has returned an average of 9 to 10% annually. Compare that to TIPS, which have averaged about 3 to 4% over the same period. So who are these dividend aristocrats? Here's a list of the top 10 dividend stocks as of 2025. These are based on dividend yield, stability, and long-term performance. Number 1 at the top of the list is Johnson & Johnson, ticker symbol J&J. Next up, number 2, we have Procter & Gamble, PG. Number 3, Coca-Cola, KO. PepsiCo, PEP. Chevron, CVX. Verizon, VZ. 3M, MMM. Pfizer, PFE. McDonald's, MCD. Realty Income Corp, O. Monthly dividend payer. So how do we calculate the return of the dividend stock over time? If a dividend stock has an average yield of 2.5% to 5.5% over 20 years, we can calculate the return, including the dividend plus the growth, for an annual return. Dividend plus growth, 8 to 10%, depending on the reinvestment and the market conditions. So how can you start investing in dividend stocks? Use a brokerage account or retirement account like an IRA. You can also consider dividend ETFs or exchange-traded funds for instant diversification. Here are some example ticker symbols: VYM, SCHD, or DVY. One option, if you don't need the income now, is to reinvest dividends to benefit from the compound growth. As you reach retirement, you can change the option from reinvesting to distribution, so you can receive the dividend like a paycheck. This is what appeals to most dividend stock investors, that comfort of knowing that you'll receive a check as you did during your working years. But we can't forget about Uncle Sam, because of course, whenever you make money, you have to pay some of it in taxes. So in order to calculate the true return of the dividend stock, we must also consider taxes, because this can affect how much of the dividend income you actually keep. If you're still working, dividend income is added on top of your earned income. Qualified dividends are taxed at 0%, 15%, or 20%, depending on your income bracket. Non-qualified dividends are taxed as ordinary income, just like wages. If you're already retired, things can get pretty interesting. If dividends push your income over certain thresholds, that can increase the portion of your Social Security that can get taxed. Up to 85% of your Social Security benefits can become taxable if your total income, including dividends, crosses $34,000 for single filers or $44,000 for married couples. And in the next video, I'll talk about some additional details to help you learn more about investing in dividend stocks or funds. Meanwhile, if you're interested in researching dividend stocks and how they impact your taxes, I'll drop a link to several calculators in the description below so you can play with it yourself during the meantime. So while dividend income is fantastic, it's important to coordinate it with your other sources of retirement income to avoid unexpected tax bumps. To wrap this up, dividend stocks offer something special: steady income potential for long-term growth and a hedge against inflation if you choose the right companies. They may not be flashy, but they're like that reliable friend who shows up with coffee and support when things get rocky. In a volatile market, that consistency is golden. You don't need to be a Wall Street pro to build wealth. You just need the right knowledge and the right strategy to become the hero of your own financial story. So now you should have a basic understanding of dividend stocks and be able to consider if this is the right investment strategy for you. In the next video, I'll pull up specific dividend stocks using their ticker symbols as well as dividend ETFs. We'll take a deep dive into what you can expect to earn from dividend stocks versus other alternatives. Thanks for joining me today on Reflections and Real Talk. Be sure to like, subscribe, and hit that bell so you don't miss the next episode. And let me know in the comments, are dividend stocks part of your portfolio? Until next time, stay smart, stay kind, and stay curious.